Karen Harris, could you add your perception to all this?
Sure. I have the pole position here where my fellow speakers have already done an excellent job providing the background on the situation in China. So I had some slides, I'm not going to use them. I'm actually just going to talk from my very narrow parochial perspective, which is as someone who works with multinational companies and investors and some Chinese companies looking at the opportunity for the private sector in China and the opportunities and concerns that I have from that perspective. So I'm going to just stipulate that China is going to be the second largest economy in the world, or the first, but it doesn't really matter that much to me. I don't need that, thank you, I'm not going to use the slides. So let's say second from a real GDP or nominal GDP perspective, with a growing middle class that I would speculate, looking at the numbers, my perspective, that looks more like a very large Poland in terms of income level than a second United States on average, so marching towards 2030. So setting that context, what are the concerns that I have today and what are we looking at? First, the credit issue, which both the speakers articulated very well. There's a fantastic study by Professor Christopher Balding, who's at Peking University, who painstakingly matched the bank's financial statements, the assets that they deployed, versus the companies to whom they deployed those assets, and the amount of the size of the checks being written back to the banks in terms of interest repayments. And the banks believed they were getting 8%, or stated they were getting 8% return on assets on average, and the payback rate was 2%. Now, with a posted policy rate of about 5% in China, that math looks really unfortunate, right? Banks are losing money, we're accumulating bad debt. I don't think anyone's arguing that the deployed assets of the banking system in China right now have a non-performing loan rate anywhere close to what is officially stated at just under 3%. Right? That just doesn't seem possible given the credit intensity of growth, given what you can observe on the ground. So that doesn't mean that China is facing a financial crisis. I want to be very clear about that. We're not talking about a second US sort of 2008 style meltdown, but rather, back to what Paul was saying, something that looks more like Japan, where your system gets, when your credit system gets clogged up and you're relying on credit for growth, then the credit gets more scarce and the growth overall slows. And the risk is there, that kind of drag on the growth rate if the model can't shift away from that. And I would argue that it's very, very hard for that to happen quickly. A second factor that I look at that concerns me is there is a high savings rate in China. But if you go below the thatch layer, what you see is that the top 15% of income earners, which is about 20,000 US a year and up, own about 90% of the wealth in China. So, and what that means is that savings rate is concentrated, and probably far more concentrated within that band, right? I don't have that data, but I would guess that the distribution is equally as skewed within that 15% group. And what that means is that this isn't a matter of, in Japan we had Mrs. Watanabe and her famous savings rate. We don't have that. This is not Mrs. Chen, who with sufficient social safety net is suddenly going to go out and start buying household items. This is a third of Chinese consumer expenditure is on food. Most people are buying basics. And so the wealth concentration is directly correlated with the fact that the wealth has been historically generated by the state-owned enterprises, who incidentally use 55% of that credit. And so until those get structurally, as my fellow speaker just mentioned, that until that gets redistributed in some way, it's going to be difficult to unlock that demand. And this is the challenge of the 13th five-year plan. It's hence the focus on supply-side reforms, which I frankly, they haven't been implemented quickly. Now that is clearly because of the the political situation leading up to the 19th plenary next year. But even so, these are not easy reforms to implement. This isn't something that can happen overnight. And I think the gap between the market expectations of a demand-driven economy in China and the reality of the difficulty of executing that transition well, and to Paul's point, China has executed very well on a lot of economic policies, that they'll suddenly panic and start reforming willy-nilly just to make things happen quickly seems implausible to me at this point. So the income inequality, that need for redistribution, that restructuring, that's sort of the internal to China factors I look at. Something that Paul said really struck me, which is that China's in a good neighborhood. And I would argue that China was in a good neighborhood. And it has been, Asia has become the center of global economic growth. Finally, for the first time in some recent economic history, income levels are high enough, combined with that large population, that there is growth being driven from that region. But my concern is that all of those stories from Japan, Taiwan, the Asian tigers, and China as the last, in my view, example, were export-led growth stories. That you found demand somewhere else, served it, and marched up the value chain until your own local economy could afford that. Now, what we saw during that 50-year, so post-World War II, when export-led growth worked, was that we were in what we call in Wonkville, where I live a lot of the time, supply-constraint growth. In other words, we had a big war. We blasted most of our capacity out of existence. I do not advocate this as an economic policy. When you have that happen, labor can command a big share of surplus, right? So labor wages go up, unions formed. We saw the Trente Glorieuses in France, the US growth, and it took about 30 years. And again, this is where labor benefits, incomes rise. We saw global wealth inequality come down during that time. What happened in the late 80s, early 90s? China added 800 million incredibly productive workers to the global workforce. And we switched from having a supply-constrained growth world to a demand-constrained growth world. In other words, we had more supply than beating hearts at the end of the value chain to buy it. And since then, wages have gone down. The competition has been around price rather than, we see a deflationary environment. Generally, obviously, places like India, Brazil, there are pockets of change. But globally, we're in a demand-constrained world. And so to have export-led growth in that environment becomes really challenging because the other factor we're seeing is capital-labor substitution. Foxconn in China is buying millions of robots. It's automating its facilities. And what I would argue is the most important, scarcest resource today is not rare earth metals or zinc or you name it, it's demand. And China knows this. And interestingly, they have it. And so where are we in the world? We have a need to shift the growth model that involves some pretty blunt forced redistribution away from SOEs into households over the next decade, however that happens. We have a demand-constrained world, and we have Xi Jinping, who is concentrating power at the center. He's taken over the PLA. He's now the Chinese equivalent of the Joint Chiefs of Staff, the anti-corruption campaign. And arguably, it's going to be without that centralized power, with a constant battle against the provinces, he could not possibly do the kinds of reforms that are necessary. So that means, what does that mean? So if you're a Chinese company, what do you see? Fantastic opportunities in places like in automation. The supply chain in China is disaggregated to the point of lunacy. It's hundreds of individual suppliers. This is why there's food safety issues, because tracking origin is incredibly difficult, substitutes along the way. There's e-commerce growing, great opportunities internally, but if you're a multinational company confronting an environment where power is being centralized, where broad-scale reforms have to happen that are redistributed towards local households in a time where demand is a precious resource, I would argue that that doesn't feel to me like a very welcoming environment going forward. And more companies there, the last point I'll make, are concerned about talking about the challenge of of regulation. For the first time in several years, AmCham, the American Chamber of Commerce's study, has had regulatory challenges at the top of its list of concerns in China. And we see profits going down, revenues going down. And now we have a new administration. We're in the United States, so talking from the perspective of US investors, we have a new administration coming in that's likely to, at the very least, have some face-saving policies that are obstructing trade with China. And the likely retribution for this at the lowest level will be making it more difficult for American companies to do business in China. There'll be something at a high level, but the real problem is that most companies, directly or indirectly, are working with the state. And if the state doesn't want to work with you, it's going to be very difficult to grow your business, right? It will be gooey, you won't get your license, it won't be top-line laws, it'll be just harder and slower. And so that's so that is the concern. So great opportunities internally. China will be a fantastic market for Chinese companies. Multinationals, I'm a little more cautious.